Right now, as you are watching this video, there is a trap being set in the silver market, and the vast majority of retail investors are walking straight into it with a smile on their face. The number everyone is talking about is $68. You have seen the headlines, you have seen the analysts, you have seen the social media posts screaming that silver is heading to $68, and if you buy now, you will be rich. But here is the brutal truth: $68 silver might be the most dangerous number in the market right now, not because it is wrong, but because of how the market is going to get there and what is going to happen to you along the way if you do not understand this setup. Stay with me for the next 30 minutes because I am going to walk you through the exact mechanism being used, the warning signs hiding in plain sight, and what you actually need to do to protect yourself and potentially profit while everyone else gets wiped out. Let us start with the current picture. Silver has been on an extraordinary run. If you have been watching the precious metal space here in the UK, you will know that silver has significantly outpaced gold over the last 18 months in terms of percentage gains. We have seen silver push through key resistance levels that had not been touched since 2011, the year silver hit its all-time high of just under $50 an ounce. The breakout above $30, then $35, then $40 has had retail investors absolutely euphoric. Forums are lit up. Telegram groups are pinging constantly. YouTube is flooded with silver to the moon content. And on the surface, you might think, what is wrong with that? Silver is going up, people are making money, what is the problem? The problem is this: when everyone is saying the same thing, when every analyst has the same price target, when every retail investor is positioned in the same direction, that is when markets do the most damage. And right now, the consensus around $68 silver is as loud and as unified as I have ever seen it in the precious metals space. That should make every single one of you deeply uncomfortable. Not because $68 is impossible, it is not, but the path to $68 is what no one is talking about. And that path has the potential to shake out the vast majority of people who are currently holding positions before silver ever gets anywhere near that level. Let me explain what I mean by a trap in market terms. A trap is when price action moves in a direction that forces the maximum number of participants to act against their own interest. You have heard of a bull trap: price rises, everyone buys, then it collapses and those latecomers are left holding losses. You have heard of a bear trap: price falls, panic sellers dump their positions, then it rockets higher and those sellers miss the entire move. What we are potentially looking at right now in silver is something more sophisticated than either of those. It is a narrative trap, and it is built around the $68 number specifically. Let us talk about where this $68 number actually comes from, because understanding the origin matters before you decide how much weight to give it. The $68 target has been circulated primarily through two channels. The first is technical analysis, specifically Fibonacci extension levels projected from the 2011 high to the 2020 low, which when extended upward produced price targets in the $65 to $72 range depending on the exact measurement technique used. The second channel is fundamental analysis based on the gold-to-silver ratio, which historically has oscillated between roughly 15:1 and 80:1, and which at current gold prices would imply a silver price somewhere in the $60 to $70 range if the ratio returned to its historical average of around 50:1. Both of these are perfectly legitimate analytical frameworks. I am not dismissing them. But here is what I want you to understand: these are the same frameworks being used by hundreds of thousands of retail investors simultaneously. And when that happens, when the same targets are being traded toward by the same crowd of people, you create something called a crowded trade. A crowded trade is not inherently bad, but it creates extreme vulnerability at specific price points. And the price point we need to talk about is not $68, it is the zone between $50 and $55, which is where the real danger lies. Here in the UK, we also have an added layer of complexity that our American counterparts sometimes overlook entirely. When we buy silver, we are buying it in US dollars, which means we are simultaneously taking a position on the GBP to USD exchange rate. Over the last 12 months, sterling has been relatively stable against the dollar, but that can change rapidly, particularly given the current uncertainty around UK economic policy. the Bank of England's interest rate trajectory, and the broader geopolitical environment affecting energy prices and trade balances. If you bought silver at $30 when the pound was at 1.28 against the dollar, your cost basis in sterling is approximately £23 and 44 pence per ounce. If silver rises to $50 but sterling simultaneously strengthens to 1.35, your gain in sterling terms is considerably smaller than the dollar gain would suggest. This is not a reason to avoid silver, it is a reason to understand your actual position before you size it. Now let us get into the meat of what I am calling the trap. The zone between $50 and $55 is unlike any other price range in silver's history. $50 is the psychological barrier. It is the number that silver touched in 1980 during the Hunt Brothers episode and again in 2011 before its catastrophic collapse. Every single person who has ever studied silver knows this number. It is the most discussed, most analyzed, most emotionally loaded price point in the entire history of the silver market. And that emotional weight is precisely what makes it dangerous. As silver approaches $50, you are going to see an enormous surge of retail buying. Everyone who has been waiting on the sidelines, everyone who told themselves "I will buy when it breaks out," is going to pile in as silver pushes through that level. Volume is going to spike. Sentiment is going to be at peak euphoria. Social media is going to be absolutely on fire. And that is exactly when the danger is greatest. Because on the other side of that retail buying frenzy are the commercial traders, the banks, the industrial users, the sophisticated institutional players who have been watching this setup build for months. The Commitment of Traders report, which is published by the CFTC and which I encourage every precious metals investor to check regularly, consistently shows that commercial traders are net short silver at levels that historically precede significant corrections. These are not dumb money. These are entities with enormous balance sheets, deep knowledge of the physical market, and the ability to withstand drawdowns that would wipe out a retail investor. When they are positioned short against a wave of retail longs, the risk is asymmetric, and it is not asymmetric in retail's favor. What typically happens in this scenario is a sharp, violent flush, a move that might take silver from $52 back down to $42 or even $38 in a matter of weeks. In percentage terms, that is a 25 to 30% decline. For someone who bought on leverage near the top, that is catastrophic. For someone who bought physical silver at £23 an ounce 18 months ago, it is uncomfortable but entirely survivable. The difference in outcomes between those two groups is not luck, it is preparation and positioning. Let me give you a specific historical example to make this concrete. In April 2011, silver did something almost identical to what I am describing. It was in a parabolic run, sentiment was at extreme highs, the $50 target was on every analyst's lips, and silver touched $49.51 on the 28th of April, 2011. Within 2 weeks, just 2 weeks, it had fallen to $33. That is a 33% collapse in 14 days. The people who bought physical silver at $20 and held through that were fine, shaken, but they held, and over time silver recovered. The people who bought on leverage near the top, or who panic sold into the flush, took losses they never recovered from. I am not predicting an identical repeat. The fundamental backdrop today is genuinely different from 2011 in several important ways. But the mechanism of how sentiment-driven markets correct is timeless, and ignoring it is not wisdom, it is complacency. Now I want to make sure this video does not come across as simply bearish on silver, because I am not bearish on silver. Quite the opposite. I think the long-term fundamental case for significantly higher silver prices is among the strongest I have ever seen for any commodity. Silver is unique among commodities in that it straddles two completely different demand categories, monetary demand and industrial demand, and both of those categories are simultaneously bullish right now. On the monetary side, we are operating in a global environment of significant debt accumulation, currency debasement concerns, and a gradual but unmistakable shift away from dollar-denominated reserve assets by a number of central banks and sovereign wealth funds. When people lose confidence in fiat currency, and that loss of confidence does not have to be dramatic or sudden to affect asset prices, they historically rotate toward hard assets, And silver benefits from that rotation disproportionately because it is dramatically cheaper than gold and therefore accessible to a much wider range of buyers. On the industrial side, the story is even more compelling when you look at the numbers. The solar panel industry alone is projected to consume silver at a rate that would absorb virtually the entire current annual mine supply within the next decade if current trends continue. Every photovoltaic cell requires silver for its electrical conductors. Electric vehicles use silver in their battery management systems, their charging infrastructure, and their onboard electronics. 5G infrastructure deployment is silver-intensive. Medical applications, from antimicrobial coatings to advanced imaging, are growing silver consumers. We are living through an industrial revolution that runs on silver, and the mining industry is structurally incapable of responding quickly enough to dramatically increase supply because the lead time from discovery to production for a new silver mine is typically 10 to 15 years. The Silver Institute's data consistently shows that we are in structural supply deficit, meaning the world is consuming more silver than it is mining. And when those above-ground stockpiles are exhausted and the deficit persists, the price response will be significant. So the $68 narrative is not wrong. The timing and the path are what need to be managed carefully. What this means practically for UK investors is that physical silver, actual coins and bars held either at home or in allocated storage, remains in my view a sound long-term holding. The Royal Mint here in the UK offers allocated silver storage that deserves serious consideration. Britannia silver coins carry the added benefit of being capital gains tax exempt for UK residents, a detail that is frequently overlooked and which can make a meaningful difference to your actual after-tax return. If you are investing in silver through ETFs or through a stocks and shares ISA using an ETC product, you need to be acutely aware of the counterparty risks and the expense ratios involved, because not all silver products carry the same risk profile. Let me share what I believe sophisticated investors are actually doing in this environment, not what they are saying publicly, but what the data suggests about their real positioning. Sophisticated investors who are genuinely bullish on silver for the long term are not buying it on leverage at $45 hoping to flip it at $68. They are accumulating physical over time, they have cost bases well below current prices, they have sized their positions such that a 30% drawdown is entirely tolerable, and they are prepared to hold for years, not months. This sounds boring. It is boring. But boring is how you build wealth in commodity markets. The exciting approach, buying leveraged ETFs or spread betting silver because you heard it is going to $68, is how you get trapped. The $68 silver trap is not necessarily a trap in the sense that silver will not eventually get there. It may well get there. But if you are positioned such that you would be forced to sell, whether because you are on margin, because you have used money you cannot afford to tie up for years, or because your emotional tolerance for volatility is lower than you think it is, then the path to $68 might take you through a 30% move that forces you out of your position right at the bottom before the real move higher begins. That is the trap. So what do you actually do with all of this? Let me give you concrete, actionable guidance tailored to the UK context. First, assess your current positioning honestly. If you have bought silver at prices significantly below where it trades today, you are in a fundamentally different position from someone considering buying now. If your cost basis is below $30 and you hold physical silver with no leverage, you have the luxury of patience. A correction to $42 does not threaten your financial situation, it is uncomfortable but not dangerous. In that case, hold, do not add on leverage, and consider using any significant spike toward $50 or above to take partial profits if you need liquidity. If you are considering entering silver for the first time now, apply extreme discipline around position sizing. The rule I use is that you should size any position such that a 40% drawdown would not cause you serious financial distress. If it would, your position is too large, reduce it until that 40% drawdown is genuinely tolerable, because then you are positioned to hold through the volatility and benefit from the longer-term case. Second, if you are investing through ISA-wrapped products, take time to understand exactly what you own. There is a significant difference between an ETC that holds allocated physical silver in your name, an ETC that holds unallocated silver representing a claim on a bullion bank, and a silver mining equity fund. These are very different risk profiles, and in a scenario where silver is rising because of stress in the financial system, which is precisely when silver's monetary value is most relevant, counterparty risk in unallocated products becomes far more material than it appears in normal conditions. Third, watch the Commitment of Traders report every week. It is published every Friday by the CFTC and it is freely available. When commercial shorts are at historically extreme levels, that is a yellow flag telling you the risk of a sharp correction is elevated. You do not have to abandon your long-term thesis, but you should avoid adding aggressively to your position in that environment. I want to close by zooming out and giving you the bigger picture, because the $68 discussion is really just one chapter in a much longer story about where we are in the global monetary and industrial system. We are living through a period of profound structural change. The energy transition is real and it is silver intensive. The fiscal positions of major governments, including the UK, are genuinely concerning on a long enough time horizon, and historically that concern has always ultimately been positive for hard asset prices. The gold-to-silver ratio sits well above its historical average, which implies that silver has significant relative upside against gold over the medium to long term. None of these dynamics have gone away. None of them will go away because silver has a bumpy few months. But here is the thing about long-term bullish cases: they do not protect you from short-term pain. They do not make volatility comfortable. They do not prevent you from making emotional decisions at exactly the wrong moment if you are not properly prepared. Understanding the setup I have described today, understanding the potential for a significant flush before the real move higher, is not pessimism, it is preparation. And preparation is what separates investors who actually capture the returns from a structural bull market from those who buy the narrative, get shaken out in a correction, and then watch from the sidelines as the thing they believed in eventually does exactly what they thought it would, but without them on board. So be patient, be sized correctly, hold physical where possible, understand the currency dimension, watch the COT data, do not use leverage you cannot sustain through a 30 to 40% drawdown, and do not let the noise around $68 cause you to abandon the discipline that will actually get you there. The silver story is compelling. The $68 target may well be conservative. But the path matters as much as the destination, and today I have tried to give you the map that most people are not showing you. If you found this useful, leave a comment below, give this video a like, and subscribe for more analysis that goes beyond the headline numbers and actually looks at what is happening underneath. I will see you in the next one.